Hey everybody, I'm Adam Morgan McCarthy, the markets reporter here at the Block. Today I'm joined by Jeff Ludgate, Thomas Kilclanis, and Andres Valencia to chat about institutional crypto in times of volatility. I've been with the Block about 7 months. I usually cover markets and companies, so I joined right around the time that everything went kind of up in the air with Terra Luna and things started crashing. So I got to experience a little bit of volatility, but I'm going to pass over to the experts now to let them introduce themselves, share a little bit more background. Do you want to take us away, Jeff?
Yeah, hi, I'm Jeff Ludgate. I represent more, the network side of this business. I've been in global telecoms for the past 20 or so years, starting with a company called IXNet, which was one of the original extranets for the financial market, and then worked with a company called Telstra, building up some of the financial practices and global WANs for banks and exchanges and hedge funds and whatnot. And now work with Avelacom. Avelacom is a kind of a specialist in bespoke trading networks for high-performing infrastructure for the banks and traders.
Awesome. Thanks for that, Jeff. And Thomas, do you want to give us a little bit more info on yourself?
Yeah, definitely. So hi, everyone. Thomas Kilclanis, general partner at Block Tower Capital, where I co-head our venture fund alongside our founders, Matt and Ari. Myself, very quickly, background in investment banking, equity research, and then the crypto space, both on the operating side at Consensus and the investing side at a generalist fund called White Star Capital, where we had launched a digital asset focused fund where we back businesses like Ledin, Paraswap, Superfluid, Rally, Index Group, and others. At Block Tower Capital, we're a crypto native asset management firm, one of the more OG ones sort of in the space. But more recently, we've evolved from being sort of solely a hedge fund, which is still our flagship vehicle today, where we had done venture in the past, to running a multitude of strategies. So we play both in sort of the directional liquid space, as well as in the market neutral liquid space, both traditional strategies like basis trading, arbitrage, but also more crypto native forms of yield generation, like lending through Maple or providing liquidity. We also run a credit strategy where we're working with Maker and Centrifuge pretty closely, as well as our recently announced venture fund, which is a $150 million fund. So excited to be here today. Thanks for having us.
Awesome. Thank you. Andres, do you want to give us a last but not least your intro?
Yeah, definitely. So I'm Andres Valencia. I'm the VP of VTP and trading operations here at 21Co, 21 Shares, the largest brand under the 21Co umbrella. My background is in ETFs. I've been here with the company about a year and a half. Previous to this, I was at JP Morgan. I helped build the ETF and the UCITS business out there. And further background at Bank of New York Mellon in the asset services space for commodities and currency funds.
Awesome. I think we have a good raft of experience there, and should make for a good conversation. So I guess we'll jump straight into the first topic if everyone's ready. And that's, what are the key systems successful shops need to have in place to navigate times of high volatility? So I guess continue the way we're going, or does anyone want to jump in first? Otherwise, I'll go back to you, Jeff, and work our way around again.
Sure. Actually, for us, volatility is something we look for actually in our clients, because we work with a lot of customers, particularly the HFTs, who thrive on the spread in the market. So when there's volatility, they tend to be very active. And so we've seen that as crypto has matured, those spreads have tightened quite a bit. And so it's actually, it allowed us to, we've been around for about 10 years or so, kind of building markets, infrastructure that caters to that world. We're at about 80 pops around the world and all the exchanges. And when the crypto exchanges started emerging, say in the past 5 or 6 years as they've matured a bit more, they set up more in a cloud environment. So we're fairly, like in our world anyways, the time it took to get from exchange to exchange was quite great. So we applied our network underneath it, and we were able to kind of tie those clouds all together, kind of tighten the speeds, between exchanges, and provide a bit more of a consistent experience, for the traders who are actually profiting from that volatility.
And then Andres, thank you, Jeff, by the way. And Andres, what's it kind of, so ETPs are more kind of like tracking things and kind of a little bit more passive. What's volatility mean for you, and what are the kind of key systems 21Co will have in place, or even beyond 21Co, things that you see in other shops and that you think are kind of worthwhile?
Yeah, definitely. I think volatility is what sets us apart. I think we pride ourselves on having like a leading research team within the organization, and the ability to kind of respond to those data market signals and be able to execute on the trading plan and be able to keep our products performing as they're designed. I think that's key. But I think what Jeff mentioned is definitely key. That maturing infrastructure it gives you kind of that edge and allows you to basically for us to perform better. As it matures.
Nice. Have you got much to add on that, Thomas, as well?
Yeah, I wouldn't say too much, but I think I echo a lot of the thoughts, right? Crypto has matured. We're the most institutional shops in the sector back in 2017, often traded custody at exchanges with sort of not that many checks and balances. Now we have a lot of that infrastructure, and some of the folks on this call have helped build that infrastructure. Everything from sort of your trading infrastructure, who you use for custody and why, how you're thinking about sort of position management and stop losses, but also things as simple as like, what is your internet infrastructure for your trading team? Is there a failover if, you know, your primary provider falls offline right when the FOMC is about to sort of announce numbers? Those are some of the things we think about. The one thing I might add actually is before we even get into sort of like the trading infrastructure, times of volatility for crypto has historically meant existential risk for a lot of businesses, right? Their volumes, which is how they generate money, are down 90+%. So I'd say before you even zoom into all the things we just talked about, there's probably an element of like foresight and planning for the bear in what is a cyclical market. And so a number of firms have sort of set out 2-3 years runway on retained earnings from the bull run aside, right? And a number of firms are making tough decisions and sort of going through cuts, although they might not need to now, but because the first thing they're trying to control for is surviving, let alone thriving in the 95% of potential outcomes. So I'd say there's also sort of that upper management, managerial sort of conversation to be had as well for a lot of market participants in the space, just given how cyclical this space is and continues to be, sort of the peaks and troughs of the bull and bear cycles, but also B, just where we are in the macro and how macro driven some of this is, and the fact that there's some uncertainty as to when things could pick up very meaningfully again, like we've seen in 2020, 2021.
Yeah, for sure. And actually, a side note on that, like, what do you think of how macro things are being so driven by macro at the moment? What do you think that means for the sector? Is it like is it a good thing? Is it sign of maturity, or are markets kind of a little bit wild right now and oversensitive to these what Chair Powell says, or what happens with inflation or GDP, or what do you make of that, Thomas?
Yeah, that's a great question. Like, I don't know what I think of it, or I don't know that that's relevant, but certainly I would echo what you said, which is like markets are being driven by macro, and it's sort of what the Fed says dictates where the market goes, and we have super high correlations across asset classes, and when the correlation breaks down lately, crypto has tended to trade like a risk asset class, right? More than a safe haven. I think if you look at the most institutional asset that we all look at, which is Bitcoin, it's a potential store of value, but not yet a defensible store of value. And so we're sort of in that in between in the adoption curve where, you know, macro is bad, Bitcoin trades down. We hope that next time macro is bad, we hope that the asset class has come a long way and it's more of a defensible asset like gold can be. So things continue to be macro driven. The benefit though this time around is, had this happened a couple of years ago, it could have very much sort of choked the sector, I think personally. Today, the sector is a lot better capitalized. We do have a number of crypto native institutions that have come in and sort of risen out of the ranks and have sort of forward planned. We have a number of traditional institutions that have moved into the space. There's a bunch of early stage to growth stage dedicated capital set aside by funds like us that's been raised that has to be deployed to the space. So I think we can weather the storm, whereas a couple of years ago, macro this sort of bearish or at least hard to navigate would have given me a lot of pause for concern. I'm curious whether Jeff, Andres, you guys echo that, but that's sort of my 2 cents on the topic.
Yeah, I saw Andres and Jeff kind of nodding along there, so let's get your guys' input as well.
Yeah, I guess my background's on the network side, so I see what our clients are doing. But I guess on the macro side, I'm probably the only one on this panel old enough to have sons who are actively trading in crypto, and so I get a lot of opinions at the dinner table as well. But I think that the reality is, as Thomas and Andres are probably seeing, the real life applications for blockchain and crypto are coming to life right now. And whereas before 2 years ago, it was all hype about prices just going up and up and up, and everybody made money. So I think this is a realization on how these actual applications are coming to real life. And ultimately, I think things would be larger in a few years, but it'd be more reality based than it was a couple of years ago when it was purely speculation.
You echo that, Andres, do you?
Yeah, definitely. I think so our research team put out a post saying that about 60% of the capital that entered the Bitcoin space entered the space in the last 2 years, and that kind of explains why everything's macro driven. So I think that it is a sign that everything's macro driven. I think that you also posted in an article that you wrote recently that there's some signs of the correlation breaking down between Bitcoin and the larger market, and I think there's enough adoption and enough value add behind crypto that we expect to see that over time.
Yeah, it was dropping down there last week. It was looking like it was kind of falling off, and then Monday, Tuesday, right before the Fed, it just came back up. But well, you actually touched on something there as well, Thomas. I was interested. You said there was some crypto native firms that have kind of risen in the last few years. Like, what kind of, do you have examples of specific firms you think that have been particularly influential in the last few years?
Yeah, definitely. I mean, look, I think at one end of the spectrum, you have the big names that have sort of gone public, right, or are close to that stage and comparable in size. So your Coinbases, your Krakens, the types. You've got some hyper-relevant infrastructure players sort of on the wallet side, your ledgers, firms that are really well capitalized, quintessential to basically everything in the space. I mean, we at Block Tower still use ledgers as an additional sort of layer of security on top of the institutional custodians that we use. You've got the institutional custodians, your Fireblocks, your Coppers, but also sort of the prime broker segment, right? Companies like sort of FalconX and Paradigm and Talos. That's infrastructure that wasn't around last time. Sort of last time we had a very sort of bearish environment for multi-months. And these firms are well capitalized, products that we all use every day that are super important. I do also want to just quickly double click on one thing. You said the correlation was sort of breaking down, just shifting gears back to something you said, the correlation was breaking down pre-FOMC and sort of went back. One thing I found super interesting recently is when correlation, so there's very little dispersion within crypto. And lately, even where crypto has correlated heavily to traditional asset classes in light of the macro, we have seen certain assets break out and trade completely counter-cyclically to the sector. And I'm thinking like things like Chili's pumping ahead of the World Cup, things like Arweave going completely the opposite direction in a good way of the market yesterday. Obviously, there are some catalysts, but we're seeing investors get more sophisticated within the space for assets that you wouldn't think of as institutional just yet. And I think that's encouraging in terms of sort of the sophistication of the flows that we're seeing in the sector. So just wanted to sort of circle back to that as well, because I thought that was something that was certainly noteworthy in the past 2-3 days alone.
Yeah, for sure. And I think Matic as well, like yesterday was up like 13% when I got up this morning in Ireland. So yeah, and I kind of like shifting it now to our kind of next topic then, I guess, and it's something that's kind of more recent. The volatility has dropped off. So I was writing about correlations falling off last week. I was also writing about volatility. I think it hit its lowest point since annualized volatility that we measure on the Block's dashboard anyway, hit like its lowest point since July 2020. So what's that kind of conversely? How do firms navigate that kind of low volatility, and how do you kind of find value in times of low volatility? Do either of you want to jump on that one, Andres or Jeff, or Thomas? I'll pick on you again.
I can jump in here. I'll give it a little bit twist. I'll tailor this to what we interpret as a bear market and essentially what we've done in bear markets. The company was essentially launched during a bear market. We find low volatility bear markets to be a time to innovate. We think that this is when you differentiate yourself from the competition, and I think we've seen this within our products that we've the partnership with S&P trying to differentiate what's the available like product range in the market. So I think in summary, this is a time to innovate for us. Volatility, it essentially gives us space to think about what's next.
So you can kind of like take a breather. Yeah.
Quote unquote, yeah.
Yeah, and I mean, I'd love to piggyback on that. Like for us, we're a multi-strategy firm, and so it's interesting, right? Some of our vehicles obviously kind of like the volatile environment, and lower volatility means maybe turning to other strategies, so like longer thesis-driven bets, and maybe sort of structuring some trades around options and other structured products. But it also means we can lean into other strategies, right? Doing more perhaps on the VC side, maybe less on the public side. Not to say that that's what we're doing, but like we do have that flexibility. And then last but not least, adopting some of the new tools that are coming to market to try and trim costs, better your infrastructure is also something that this type of sort of environment is ripe for, right? If you look at like the DeFi segment, today that's an asset class that like you have professional funds with institutional LPs looking at, right? Yet you don't have tools like a Falcon X or a Talos for DeFi. And so we in our portfolio, and I know there are a couple other competitors out there, have backed companies that are building in this space, that are building sort of risk management tools to allow our market neutral fund, for example, to be able to hold a decentralized stablecoin, but sleep at night and know that if it depegs to 95 cents and that's a sign of like, pretty severe smoke, it'll auto liquidate, right? So I'd say the third prong really beyond, trading stuff other than volatility, taking other investment horizons, second, sort of going to privates or other strategies. The third prong really is sort of dog fooding our own industry and using some of the stuff to better your infrastructure, trim costs, whatever it might be.
Cool. Do you have anything to add on that, Jeff?
I guess just a little bit. I'm not as directly involved as the two other panelists on this, but I guess in terms of a lot of these crypto native firms maturing, they're also starting to develop more infrastructure that models what the TradFi guys had. So like on the physical side, actually getting closer to the exchanges physically, around the world, maybe putting some presence like in Tokyo or in Dublin or in London, for example, and then kind of streamlining that performance between exchanges, like we mentioned earlier. So they're kind of coming up to speed to kind of model what the legacy companies are doing, because many of those companies are actually in crypto as well. So they're doing that to kind of catch up.
Yeah, and I guess just kind of like jumping off that one as well, it's kind of, what do you guys think of some of these like kind of institutional plays that have come out of the woodwork now in the last few months? And I know like Schwab and Citadel Securities have launched EDX markets, and we've seen this in the past with maybe IrisX or Backed, and hasn't like, some of those haven't kind of taken off as maybe spectacularly as they might have hoped. But what do you guys think of these institutional plays stepping in now as well, and what does that bring to the space?
Yeah, I'd love to jump in there. Like, I think the difference, and you sort of hit on it implicitly, is this time around it's the TradFi institutions launching these products, whereas last time around it was crypto native firms trying to cater to institutions that weren't ready to jump in yet. And so that's one material difference, right? A Fidelity or a Schwab telling us we're turning crypto on, or a NASDAQ getting involved, or JP Morgan with what they announced yesterday. That's sort of materially more comforting to their peers and to other institutions than ErisX or Backed launching. Although those are great teams and they've built great products. So I think that's observation number one that really jumps out to me. We've sort of crossed the chasm, right? What was last cycle sort of POCs from institutions is now production grade products, and they're sort of expanding the pie for retail as well, right? But also the institutional piece of the pie, and we're starting to see some of that stuff in production, which I hope we'll get to in this panel.
Nice. You got anything to add there, Jeff or Andres?
No, I actually have more questions myself, I suppose. Like you mentioned before, JP Morgan's announcement the other recently, and then like a Fidelity making multiple announcements of their plunge into the market. I was at Consensus back in Austin in June, and I think they had like 90 people there. So it's just a symbol of like really big money getting interested in this space, and when it's going to have that impact, I guess we're all kind of watching to see how it evolves. So, but it just seems like another level in terms of the institutional money being invested in this market.
Yeah, and I was chatting to someone recently. I think they said that it's interesting it's coming in now, and like don't expect it to change too much now, but these firms are ready to, once things kick off again, these firms are ready to start deploying and ready to start kind of being reactive, and that's when we might see it kind of get more interesting. Now that they're here, maybe in 6 months' time when things pick up, or maybe longer term, we'll see these firms kind of get involved. What do you think of that, Andres, or got anything to add?
Yeah, definitely. I think it's a sign of mainstream adoption. I mean, we've had multiple conversations with a lot of these larger players. They definitely want to participate in the space. I think it's a matter of when do they have the green signal from like regulatory authorities and say, you know what, you can enter the space and unlock capital that's going to come into the crypto area.
Yeah, I love that you hit on the regulators, because that's kind of the other piece of the puzzle, right? The more institutions pay, like the more price goes up, volumes go up, even sadly, the more folks get burned, there are rug pull scams, but also the more we have institutions, the more it becomes important that regulators adapt either existing rules or create new rules. And I think for better or for worse, like we have more regulatory attention than ever. And that's hopefully going to be another major catalyst. If you look at what the EU's done with MiCA, that really helps clear up like where you can and can't play as an institutional player with crypto. And a lot of folks are just on the sidelines, like waiting for clarity. They now understand it. They now have the tools, right? But like, is their compliance department okay with it? Is their chief risk officer okay with it, right? And I think regulation, to Andres's point, will be a major unlock for that. And things are positively trending. And like, we have the attention of lawmakers, regulators, and I'd say most of them are relatively well informed. They've done their homework. Whereas a couple of years ago, it was still like, they couldn't tell you what the difference between Bitcoin and Ethereum was.
Yeah, so it's much easier to kind of play the game when you know the rules, and it's kind of, that's really helpful then. And I guess moving on then to like, where are we seeing improvements in institutional infrastructure recently, specifically? Like, what specific improvements have really kind of stood out over the last 12 to 18 months? Do you want to take this, Jeff, or Thomas, or Andres?
I can come up with a personal story with a company.
That'd be great. Yeah.
Yeah, I mean, we built our whole infrastructure because there was nobody that can actually support a crypto ETP. So fund admins wouldn't touch it, custodians wouldn't touch it. There just wasn't an end-to-end solution. So a system we call Onyx is essentially a system built to run an ETP end-to-end, and by us and by also third parties as well. But essentially, like lately, you've seen a lot of these larger players of the fund admin spaces enter that space and be willing to actually support crypto ETPs. It's just a different approach to it, but essentially it's a sign that the infrastructure is maturing. I think custody is another big one. There's something that the industry changes every 3 months, right? So every 3 months the industry is innovating and basically contributes to actually being able to build the infrastructure that we need to run our products more efficiently.
Yeah, I wholeheartedly echo some of those points, like custody, staking, the underlying networks themselves, whether that be improvement to the existing L1s or new L1s that sort of have higher performance grade, or L2s, exchanges, institutional and retail, but like also fund admins, accountants, auditors, like all of that infrastructure has materially improved. Like I'll give you one concrete example, sort of in venture land, like you really didn't have the equivalent of a 4.9A valuation for tokens up until like a couple months ago. That is slowly but surely becoming best practice, right? It was really hard 24 months ago for us to find an auditor for our fund who sort of like, we didn't have to spend a disproportionate amount of time teaching them while they were billing us, right? All of that stuff has reversed quite a bit. The other thing goes back to what I was saying earlier is like, for all those more capital markets sort of building blocks, custody, staking, exchanges, we now have a pretty functional decentralized alternative to all those centralized options. So wave one was like Coinbase, BitGo, et cetera. We now, and sort of Figment, we now have Lido and Uniswap and sort of all these decentralized options as well. And I think that's been a major difference in the past 18, 24 months, right? You can be a sort of institutional crypto fund and mainly trade and leverage decentralized infrastructure as opposed to centralized infrastructure.
Cool. That's they're very good points. And Jeff, I think you touched on some stuff earlier about kind of infrastructure as well, but you also, if you got anything else to add on this.
Yeah, I guess more exchanges are emerging around the world. Most of them in the northern hemisphere, but we're starting to see things like emerge in Brazil, for example, in Argentina. I wouldn't be surprised to see things coming out of like South Africa, in the Middle East, as money is moving, to these regions. And so again, it kind of takes kind of the streamlining of this kind of a cloud infrastructure, and then finding out where there's efficiencies that we can kind of add with our kind of dedicated type of services. There's also the other technologies evolving that are streamlining the processing of blockchain, because there's a lot of congestion as blocks are verified. So that type of thing is kind of evolving as we go along, and as the market gets bigger, then those things are being set up now to kind of accommodate those changes in technology.
For sure. I guess then, as the market gets bigger and as we move on to that, it gets bigger, what can we glean from improvements in TradFi and efficiencies in TradFi? So like traditional kind of finance, what do we see there that we could still improve upon? What efficiencies exist there that, you know, crypto are kind of glaringly missing at the moment?
Yeah, I'd love to kick this one off, because one theme
Awesome.
we've been spending a lot of time in across the firm at Block Tower, across those 4 strategies I mentioned earlier, is sort of private credit or an institutional credit. And so I'm talking, you know, in our venture fund, we've backed and announced investments in Centrifuge and in Maple. And really sort of like, if you look at this, and our head of credit, Kevin Miao, wrote a great piece on Packy McCormick's newsletter and a couple good posts on the Maker forums. But if you look at the securitization process sort of in TradFi, to your point, it's, I mean, archaic, right? Like, you've got 9 different steps for just the monthly flows of payments. You've got 14 different cooks in the kitchen. And some of these platforms, albeit the Centrifuges and Maple of the world, you've had to be a little bit manual to get things up and running. You've had to do things that don't scale to sort of have people adopt these tools before they're perfect UX, perfect UI. But they do simplify these processes quite a bit. So the whole trend of sort of replatforming private credit, bringing real world assets on chain, is something that we're particularly excited about. And we're starting to see breakthroughs in. You look at platforms like Maple. At their peak, they had about $600 million of TVL, and they were replatforming most of the crypto native lending, right? The Block Tower lending to Jane Street, the Jane Street lending to Genesis, and so on and so forth. You get platforms like Centrifuge, they're actually addressing totally like crypto agnostic types of borrowings, and they're replatforming like a freight company's working invoices, right? And they've had like some near $200 million of issuances to date. Tie into that sort of what you saw with JP Morgan yesterday. I think the tip of the iceberg is out, and that's a theme we're super excited, because it brings tangible improvements to a concretely, completely archaic process that costs billions of dollars at scale globally per year. And it's ready to do that, if not today, in the very near future. So I think that's one area that we're just like super excited about, and continue to spend time in sort of as users, right? Through our credit strategy, through our market neutral fund. But also as investors, we've backed some of the lending platforms themselves, but they're still missing bits and pieces of the ecosystem, right? Who's going to get, this is a big vision, lots of people are working on it, but no one's gotten it right. Like, who's going to get decentralized credit scores, right? What's the analog for credit default protection? Like, or is it more insurance products? So blossoming ecosystem that's starting to get some attention. Historically was sort of not the most shiny area of crypto to build in, right? It's kind of like when it's DeFi summer and everything's going up and to the right by hundreds of percent, who's going to be interested in a 20% sort of short-term note? Not many. But I think the time is right to replatform a lot of that stuff.
Yes, that kind of brings it back to the point earlier when we're kind of lower volatility times, or building a bear market, like Andre said. It's kind of it's a good time now to kind of take advantage of the kind of breather and do the things that need to be kind of put in place for future success. And even touching on what you said, like talking about improving archaic processes. I think even as the Deputy Governor of the Bank of England was saying the exact same thing recently about kind of why can't we tokenize things to improve the kind of clearing process or transaction kind of financial markets infrastructure. And yeah, I definitely kind of hear your point being echoed elsewhere. And I see you nodding as well, Andres. You've got something to add there, or do you want to jump in?
Yeah, I mean, I think Thomas summarized it perfectly. I mean, it's the future, right? So like, and when we define this internally, we always look at convergence. So it's like, where does TradFi meet the decentralized world? And it's something we continue to talk about. We do have a token business like within our organization, Amoon. And somewhere in the future, we see these two brands converging. So I think it was perfectly summarized. Yeah.
And how long ago were you said you were with JP Morgan before 21Co, were you?
Yeah.
Andres, how long ago was that, if you don't mind asking? Was that?
That was quite a while, but so I was started there 2015.
Was crypto on their radar then? Was it anything that they were thinking about, or because
Yeah, so I was part of asset management, and it started ringing bells in asset management right when I was making the transition to 21 shares. So.
Yeah, it's interesting because I see Jamie Dimon kind of, when he gets a chance, he's critical. But yesterday they were obviously involved with it. I think it was DBS then in Singapore. So it's interesting. And so I'll jump over to you, Jeff. If you've got anything else to add here, it'd be great.
No, I agree with much of what Thomas was summarizing there in terms of again the blockchain just becoming more of a reality in real life applications and digitizing hard assets that people can see some like tangible investment as opposed to just kind of a, Ethereum was a word that just was a mystery until we started applying, the ability to actually digitize an office building or a house or like insurance markets, as Thomas mentioned there before. So it's just the realization of this as a practical technology.
And what about
it's kind of wild how much of traditional finance is literally just like a patchwork of spreadsheets and PDFs and like really just like not very robust infrastructure. And sort of in my banking career, I was an equity research analyst covering banks. And it's crazy how that translates to like ballooning costs for a lot of organizations, right? One of the stocks I covered was Deutsche Bank. One of the biggest problems they continue to face today is they have one of the largest back offices in the industry. And part of that is because they run some 20 plus operating systems with incompatible softwares across the bank, across the front to back office, which just means so much manual reconciliation. And frankly, if you get it wrong, you're opening yourself to either fines or operational risk hits. So like this stuff truly matters. And while it's been talked about for the better part of since crypto's been around, I think we're just starting to scratch the surface of like some of these firms taking the stuff to production, right? The early sort of use cases were like Axoni and Figure or some of the crypto native firms. But now you're seeing Andres's former employer, JP, you're seeing a number of other banks sort of like launch real products that they are using with their institutional and sort of corporate clients.
Yeah, definitely. And I mean, I cover it every day, so I see like a lot of it. And even things like just before now, as I was finishing off a piece on Goldman Sachs, are working with MSCI and Coinmetrics to put together some kind of indexing so that they can specify like crypto specification kind of software for hedge funds and money managers. And yeah, it's definitely a lot of like really encouraging improvements there and developments. But I guess looking at maybe what stuff still differs, what's looking at the positives of TradFi, there must be some positives of institutional TradFi that maybe traditional finance that maybe they're still missing from crypto. If there's anything that glaring that you think could still be cryptocurrency, institutional crypto could still improve upon.
I think it's a maturity. I think that's definitely a big aspect of TradFi. TradFi, when you want to enact strategies, and I'm sure Thomas, you can add on this. You have a lot of options. You have a lot of players that you can go to. We've seen this improving over time in the crypto space, but I think it's something that we're still quite a bit behind. That maturity aspect and kind of that regulatory framework around the TradFi space, I think it's going to unlock a lot of potential for the crypto space.
Yeah, I mean, the Bitcoin paper was only 14, I think this week, was it? It was Monday, it was only 14 years old. Have you got anything to add there, Jeff?
I think I just mentioned it briefly. I think the big challenge is going to be navigating all these regulatory hurdles to deploy these applications and technologies, because there's a lot of ideas that are out there, like revolutionizing pharmaceutical industry or insurance industry, but there's a lot of really embedded interests that are protecting the way things are now. So I think the technologies there's probably just going to be a lot of organizational and political work that's going to have to be done to kind of open up these markets to have them really be deployed to the full potential. It's like it has been with a lot of technology that exists today, but this one's really going to affect some big businesses, and I don't know how quickly they can be deployed unless they get buy-in, from the existing players that are there today.
Yeah, and maybe one more thing that jumps to mind on that question, Adam, for me is like, so in TradFi, like it's well understood what's commoditized, where you make money, right? But in crypto, that cost structure isn't the same everywhere. Some stuff that is rent extracting or sort of value creating in TradFi is free and completely open source. And JP Morgan can fork Aave and build their own implementation and so on and so forth. But then some stuff that's commoditized in TradFi, like custody, right? Which is really just kind of like not that expensive. In crypto is actually quite expensive. And so if you go back to what I was saying earlier about replatforming real world assets, that is a hurdle, right? If you're just like tokenizing a fintech 2.0 loan from like a Series C company, like a lot of sort of the Web2 lenders do, but then you're paying like 50 to 60 bips on the AUM for custody at a large institutional crypto custodian, that does create some serious business considerations. And so I'm not necessarily saying what needs to happen is margin compression, right? Like these companies charge a certain price because what they do is immensely technically complicated. But it does beg the question of like, do business model need to be tweaked a little bit? Where is value going to be extracted versus created? And I think that's one thing that as we add some of these building blocks to the industry, right? A lot of the stuff in this industry starts as a feature and then they build a product around it. How's that going to shake out? That's one question that I think both from the VC lens, but also from like sort of Block Tower Capital asset management firm lens, we ask ourselves regularly and sort of try to revisit very periodically.
For sure. Have you guys got anything else to add on that there from Andres or Jeff? Because I think Thomas has some interesting points as well.
Yeah, I mean, we've seen some of those margin compressions in the last year alone. So I expect as more players come into the space, like Thomas mentioned, you'll see more of that. But definitely, like you need that. There's economies of scale to continue to build within the crypto space and make it more mainstream.
And on custody, Thomas, custody is quite a. You're saying custody is quite like a difficult thing in crypto, or could you explain that a little bit?
I think custody is more difficult in crypto than it is in TradFi, right? Like you lose your private keys and you're in big trouble. Ethos is something that's hard to solve for, that people are willing to pay a premium for, to sort of not have to deal with individually and to have best in class practices. That said, like it's still a problem in crypto in that A, it's expensive, and B, if you zoom out of the institutional world and you look at the broader segment, like not everyone wants to be their own bank, but not everyone wants the app to hold your data, right? So what's the in between? One thing I'm super excited about is things like, I guess, Fireblocks in the institutional realms, but also like DFNS and Entropy and Lit Protocol and the more B2C or B2B2C sort of realm, where you can enable, for example, like Thomas to build a dApp that is non-custodial, i.e. I am not custodying you, Adam, your private keys as a user, say for my Web3 game, for example, but also you are not holding your private keys. You don't have to deal with being your own bank. So what actually happens with those solutions in a very simplified way is like your keys are being stored sort of in the cloud and reconciled with MPC. And I think you're going to see a number of sort of ameliorations around key management, custody, additional layers of sort of security sort of in the cloud or other for both the retail facing and the institutional facing custodians. So I think price and where that lands. And I do think to Andres' point, there is already margin compression. That's why you see a lot of the custodians becoming sort of prime brokers, right? They're offering OTC, they're offering trade, they're offering DeFi integrations. But I think sort of how custody gets priced and how we can make custody better, notably for that B2C or B2B2C segment, are two sort of important questions that the industry is still working through.
For sure. And have you got anything to add there, Jeff? I see nodding away there.
I'm listening to the. I think Thomas and Andres are a little more closer to the creation of these products and services. But I have a question back to them. I'm wondering how global are these applications in terms of what's being generated here, like in the U.S. and in Europe, and how would they be deployed, internationally? Is there more uptake like here in the U.S. market or in the European market, or is it something that you're seeing some of these products and services being deployed on a global level?
Yeah, I'll let Andres jump in first because they actually do deploy some of these and cater to some of these customers around the globe. So I'll riff off what you have to say, but I'd love your answer first if you don't mind.
Yeah, definitely. So I think the solutions themselves are global. And I think, I don't want to harp on kind of what I've said before, but regulatory framework is key. Like that's the differentiation factor between like what a custodian offers in one region versus another. It also defines what we can use depending on where we're operating, and of course we operate somewhere in the middle between the decentralized and centralized world. But I think those are key to us, how we think about product and how we think about custodian services, but also how it's going to develop again in the mainstream world in the future. But the services themselves, I see them like they're global, they're on chain, they're adapted broadly, they have multiple uses. They do get more and more streamlined, more secure as time goes on. So that'll be my take.
Yeah, I think I agree with that. So far, adoption's been pretty global. I mean, is sort of like we all sit, I think, in the US on this call, so we might have a bit of a US-centric view, and I'm European and French, and we have European investors like the French sovereign, actually. But and I can say maybe that institutionally Europe's a little behind the US on crypto, but if you look at regulation, they're probably a little ahead. And so could that reverse really quickly next year? Plausibly, very much yes is my answer. So I think these things are global from day one. Back to what we were talking about earlier, sort of all four of us, regulation is going to be a big unlock as to whether some region sort of wins the way that like the US kind of in Silicon Valley kind of won the internet. Today, it feels like the playing field's fairly level, and the infrastructure, the products sort of address a global customer base. So for me, one of the key swing factors is going to be sort of the either harmony between or discrepancies between the global regulatory regime.
Yeah, it's actually interesting that you touch on that, because as you touched on the top of the call, you're talking about MiCA and how that's kind of like developing. It's quite it's kind of developing, and it's quite interesting to see like the 27 states in Europe kind of developing that, working on it quite harmoniously. Well, pretty harmoniously. These things take time, but they seem to be getting done. And do you think that you think that's possibly going to be an issue for the US, and you've got this kind of clash of heads, I guess, between the CFTC and the SEC, and where does it fall between those two? Is that an issue that there's not one body that this is falling under yet, or what do you think the main issues for the US that might be cause for concern with Europe kind of stealing the charge and going forward?
Yeah, so this is a personal view, not the views of the firm.
Yeah.
But look, I mean, couple things. I think one, it's very odd to be regulating such a big topic issue in the midst of an election year, because I don't know that everyone's speaking their mind freely. For better or worse, again, I'm not saying, things will be better with A or B, but certainly like just in the political system, you've got politicians that are sort of like shilling their book and who sort of brings them campaign dollars, and they may understand the sector or not understand it at all, but still have a strong and loud opinion. So that's one sort of problem. The other problem, to your point, is turf wars between regulators. My hope, and I think the direction in which things are trending, is in the next 1 to 2 years, we'll have a lot more clarity, whether that's a new regulatory body or whether that falls under the purview of existing regulatory bodies. I think the industry is very open-minded. The industry sort of welcomes pragmatic regulation for sure. No one wants the sort of Celsius fiascos of the world to happen again. What's odd is, back to sort of what I was saying with point one, like you have a lot of regulators sort of putting out headlines. They're like, DeFi is bad. But they sort of let Celsius run free when, I mean, if you were paying attention, like you wouldn't have had your money there, right? And you would have warned retail consumers. So for me, it's like trying to weed out like the actual sort of what we're trying to achieve versus the interest, and then the turf wars. That'll probably take a little bit of time to play out. But curious to what Jeff, Andres, and you, Adam, think.
Yeah. Have you got anything to add there, Jeff? You guys probably know more than me on this.
I think Andres has probably more professional opinion than I do. So
No, I'm actually going to steer away from that question. What I kept saying is, I think the regulatory approvals in Switzerland is in part what has made us successful. So like they opened the arms to our product, and so allowed us to launch crypto ETPs. So in our eyes, we're waiting for that same approval in the US. And I think once it does happen, like we're personally waiting for it to happen to bring our brand to the US as well. So.
And to your first question, Adam, around what it takes to weather this environment, like it's funny, right? If you're more established, you're sort of like, yeah, come regulate me. I've got the dollars to be able to absorb the cost that it takes to get regulated. Versus if you're a young upstart, you're like, no, please don't regulate us yet. I haven't hit scale. Like it's gonna be really hard for me to comply, even if I try my best efforts. I'm oversimplifying at both ends on the spectrum. And I think you can infer some of the chatter from crypto Twitter that I'm referring to. Not to say I sort of align with one or the other. I think often when you have polarized views, that's sort of right answer somewhere on the spectrum. But that's certainly an interesting dynamic that we're seeing play out as well, right? Who's lobbying for what? What does that mean for innovation? What does that mean for industry consolidation or not? Number of intertwined issues within that will be sort of fascinating to watch unfold.
Nice. And I guess one thing to add an observation is this: at the exchange level, they seem to be more boasting of their ability to deal with regulators now. So it's more of a selling point than it was before.
Yeah.
You see Sam Bankman-Fried, on the air like practically every week, and sometimes he's in Washington, occasionally wearing a suit. So they are positioning themselves to be, players in the traditional space, and being regulated and respected in that part is a big part of them establishing themselves. So.
Yeah, and I guess that kind of comes back to Thomas's point about these guys that have later in the stage and they've got like more of a wealth to sit back on when they can accept this kind of regulation. So maybe it'll be interesting in a few years. We'll have pseudonymous people on Twitter asking for regulation because they can handle it.
Yeah,
So anything could happen. But I think we're kind of coming up right around now for questions. But before we kick off, there, I actually had one from earlier that I forgot to ask you, Thomas. You touched on very basic issues like if Wi-Fi went down or if the internet provider wasn't able to, failed. Has anything like that ever happened? I think so basic, or any examples of horror stories like that?
Yeah, so I mean, it hasn't happened because we've had policies, but like certainly, look, our flagship, our HQ is in Miami. It's a region that it's like, and in Brickell in Miami, there's a bunch of construction. Sometimes the weather is not great. I mean, even if you live in the best infrastructure in the world, sometimes your internet will go down for 10 minutes. So we, as one example, have multiple internet providers, and even if one is not completely down, but its speed is below a certain threshold, we swap out to the other one. So I'm assuming any institutional and sort of large crypto trading shop has something of the kind. Same goes for sort of all things, like compliance and like email protection, right? The amount of phishing that goes on in the industry. And if you think about how dangerous that could be with bearer assets, like crypto assets, that's pretty frightening. You have to have the right checks and balances in place. So I think most firms that have been most firms, frankly, that have sort of been in this market since like 2016, 2017, and sort of seen some of their competitors blow up for mismanaging those issues, have addressed those pretty head on and have the right fail safes in position. And some of that goes to the quality of like the actual infrastructure and some of the similar things you'd have in TradFi, back to what Jeff was saying earlier, right? In terms of like having your servers closer to you physically, things like that.
Yeah, so those fail safes that it kind of are in TradFi are kind of leaking into crypto now, and as the market matures more, I guess, as you touched on a few times, Andres, with maturity, we're kind of getting more of these kind of fail safes that we have in traditional finance. But I guess on that point, any kind of particular horror stories of you have to share, either of you, Jeff or Andres, before we jump on to the Q&A? Anything anecdotal?
Thankfully, no horror stories. I think a lot of it goes into like looking at a lot of those that criteria when you're running DD or due diligence on your providers. Like you need to ensure all those safeguards are in place. You need to make sure you're doing business with the right people, and then kind of front running all those potential issues. So yeah, thankfully nothing yet. So.
Yeah, and that you're working with like ethical actors, right? I think a number of folks in the industry have seen that some market makers have front run their orders, and that at some crypto custody firms, it actually takes a very narrow set of people to be able to sort of run away with the private keys. So like you really have to diligence third-party providers. Like you need to lean on third-party providers because it's too complex to build everything. And frankly, for risk management purposes as well, I think if you're an LP allocating to an institutional crypto fund, you want them to use external providers as well. But the LPs and the teams running these funds or building products like Andres need to be diligencing who they're working with, and to do sort of a thorough like vendor procurement process for sure.
Is that something you kind of echo as well, Jeff? The kind of due diligence process and make sure you're working with ethical actors all seems quite fair.
Yeah, and I guess we in back to the adapting to TradFi. I guess some of the exchanges, I think there might have to be like a kind of a hybrid between hosting in AWS and actually have a physical presence, because AWS isn't perfect. Occasionally a zone or a region might go offline or go down for a brief time, and traditional exchanges build an enormous amount of redundancy into their infrastructure, so that rarely happens. So as these become so significant in everyday, life, there might be some combination, I think, of physical plus cloud in terms of how they're set up.
Cool. Well, thanks for answering all my questions. I appreciate entertaining them. So, but now I'll push on to. I think we have some questions in the chat, so you guys can type back to them, or I can just pitch them straight to you. So, I guess I saw one here from Ryan Spagnolo. Hopefully, I'm saying that right. What are the big takeaways from Celsius and Voyager failures, among others? Is it down to new regulation to stop these scenarios repeating in the future? So I guess, is it down to just new regulation, or is there other things we can do? And yeah,
I think that's multi-pronged, right? Like, so yeah, regulators, I mean, these are centralized solutions. They're basically operating what is the equivalent of a bank, but with crypto assets. Now, granted, because the legal status of crypto is or was a little bit more in the opaque or the gray, it wasn't obvious that these things should be regulated like banks. But if you look at what like the BlockFis and the Ledins of the world is, they're very much moving towards getting banking licenses over time. So yes, regulation is one of the fixes, but it goes beyond that, right? Like, it's on the responsibilities of the investor community, the VCs in the space. It's on the responsibility of the lending desks in the space. It's on the responsibility of the users. So like investors, I mean, objectively, if I say this, like, we led in seed round on my old fund, White Star Capital, and Ledin was one of the only CeFi lenders that did not take a single hit or loss during this whole turmoil, right? And the reason we were comfortable underwriting that, while we had surveyed a lot of the other players, is Ledin's unit economics made sense. They were profitable without a native token for a centralized company. Their loan economics made sense, but also B, their risk management was super tight. And that is why they grew slower than a lot of their peers, but they grew at a they were able to, like, yeah, today they're one of the largest actors in the sector, but for a long time, they were the slower one in the race. So that's sort of on investors to do their homework. And if it's too good to be true, something probably sniffs off. You should be thinking about it. It's not because we're in a period of irrational exuberance that you need to sort of be pursuing the fastest growing, has the biggest AUM assets. On the OTC desks, like, the industry was extending credit sort of probably too generously with too few checks and balances. And so that's not to name any single lending desk, but no one knew who was exposed to who in what proportions. And a lot of these deals get done on Telegram. And then as far as the users go, like, listen, like 20% is not a savings account. It's a fund, and funds blow up. And so that's just financial education that comes down to the individual level, but it also comes down to just like society, right? Like, we probably need to do a better job in the US, at least, of making sure that people are more financially literate, because a lot of the people who got hurt in the Celsius sort of fiasco I would venture are people who had their entire life savings over there and who felt like it was safe, right? They believed the slogan, unbank yourself, come to Celsius, your assets are safer here, you own your assets. When in reality, it was quite the inverse. They were investing in a money market fund that was taking a lot of risk to grow the top line at all costs and eventually try to go public quickly. So I don't know, that's just my 2 cents. I think the responsibility is shared across everyone along the value chain in the industry.
Yeah, I've often thought that maybe financial literacy is something that can be definitely improved, and I mean, maybe it's on firms to kind of promote that themselves, or maybe it's like if you're renting a line bike, Uber line bike, you have to do a 5-step test before you're allowed to take it on the road. If you're investing a lot of money in a 20% yield fund, maybe you should be able to answer some questions before you put your life savings everywhere. What do you think, Jeff? You got anything to
Well, these institutions evolve so differently than traditional finance, who, started as right next to me is the Bank of America. They started as the Bank of Italy here in San Francisco, right? It's grew and grew and grew, and they became this big monster. But these large institutions are evolving, and they're coming out of nowhere within years, and ultimately, but they're not really headquartered anywhere either. So who has responsibility for kind of reining them in, and also making sure that they have some kind of controls or stress tests and everything else to be operated like a traditional, financial holding company that's managing that many assets? Like, I think those are the kind of the questions you want to ask, like who ultimately is responsible for keeping an eye on them? We'll try to do what we can here in the US, but they're going to be sprouting out all over the place. Is there some kind of authority that's going to have some say in how they take shape and they're managed going forward?
Yeah, like is there going to be some
more questions, I guess, and answers.
Yeah, is there going to be some kind of global standard, maybe, that, like, you can't just have these firms popping up in Europe, and then if they reach a roadblock there, they just move elsewhere? Well, who knows? It's an interesting question. It probably raises more questions, but have you got anything to add, Andres?
I mean, I fully agree with both of you. I think that's a good summary of it. I think there's a small silver lining for the industry, and that's essentially anything that's actually being paid out of that insolvency is actually coming from DeFi loans. So it speaks positively of the infrastructure that we're creating, and and hopefully that piece gives people more credibility into the DeFi world.
Brilliant. I think there's some other questions here. Let me just check these. There's some more direct questions for you, Thomas. I don't know if you can type back to these, or can you see?
I can speak to it really quickly. The question I think was around, so we just recently announced a follow-on investment in Centrifuge, where we had prior announced a first investment. Centrifuge is a platform that's looking to re-platform private credit, specifically sort of real-world assets. So zooming out of like Genesis, Block Tower, Jane Street, going to like freight companies and stuff, and fintech companies and stuff like that. The question was around sort of what are the hurdles for the space, right? As I mentioned, Centrifuge has issued about $180 million loans since inception. They haven't issued billions of dollars of loans just yet. I think there are probably two things that are sort of holding the space back and that we're actively working on. One is just sort of education in crypto literacy and sort of solving the problem of what historically has been adverse selection. Some of the lenders that have adopted these new, harder to use solutions haven't always been the best assets, the one that you want to sort of showcase to grow platforms. So you've sort of been, a lot of these platforms like Centrifuge have been building sort of slowly, doing things that don't scale, being really prudent on underwriting, but have had slim pickings in terms of what assets they could show on platform. And so what we're doing, what others in the space like Parify, DCG, who are sort of, or Arca, who are sort of active in the space, are doing is like showing the traditional institutions that the crypto institutions are sort of showing how this stuff works, and then let the sort of TradFi world figure it out as well, based on us hopefully being some kind of the shepherds for it. So more education, more awareness, lowering the barriers to entry, at least from a sort of like preconceived idea perception. The second is, while the credit protocols for RWAs, or I hate calling them RWAs because that's risk-weighted assets in finance talk, not real-world assets. But anyways, at this point, the buzzword has caught on, so I guess I'll run with it. Is there are a bunch of pieces of the ecosystem beyond the lending protocols themselves that are missing, right? Whether it's things like arrangers that help you go from like a crypto native credit line with Maker to a regulated stablecoin like a USDC or a Paxos dollar, right? Like, that's why Maker, with its endgame plan, is building things like the MetaDAOs, and we're playing a role in that. There are other pieces of the ecosystem like credit scoring, like credit default swaps, that still need to be built out for this stuff to get adopted at scale. But we're closer than ever, and that space has more attention than ever. And it has attention in a way that's really unique, in that it's bottom up from the crypto native ecosystem, but also top down from the Apollos and JP Morgans of the world. And so we're very excited about that theme on an 18 to 36 months view.
Awesome. Thanks for asking the question, John, and seriously appreciate the response, Thomas. I actually am interested in Nitesh's question here as well, about how, I mean, at the moment, like volatility and inflation in national currencies and LATAM, crypto's kind of doing its job, doing what it's made for, and it's become pretty useful. I guess it comes back to what you say, Jeff, but it's quite, it's global, it's everywhere. So I guess you're seeing crypto kind of perform differently maybe in LATAM countries than you are seeing it perform maybe in North America at the moment, during the kind of, while it's tracking interest rate increases and falling off a cliff, and then kind of zigzagging and whipsawing when Jerome Powell talks in South America. I mean, according to Nishesh here, it's working quite well. What do you guys make of that?
Well, again, these are personal opinions, I guess, and observations, but it seems like, especially when we hear about Argentina, Argentina's like 80% monthly inflation or something like that. Like, as opposed to the forced deployment of Bitcoin in El Salvador, this might be like the natural deployment of this in regions where it makes sense, as a hedge against inflation, as a hedge against your local currency going out of control. So maybe this will be something that really helps it kind of take off down there in a practical sense.
What do you make of that, Andres? Do you second that here?
Definitely, I think it's innovation in a bear market, right? So it's actually putting real value behind these use cases and building off of it. So I think this is what crypto is all about. Where can you add value with this technology?
Awesome.
Yeah, it's like the real original promise of crypto.
Yeah.
Stablecoins initially served actually the crypto native market that needed it for like a place to park their trading profits. But it's finally branching out into what we're most excited about, I think, as an industry, which is like sort of banking the unbanked, or giving them access to less volatile currencies, right? In many respects, like Bitcoin's down this year, sure, but it's down less than tech stocks or a lot of tech stocks. So even Bitcoin's proven it can sort of be a decent mean of payment relative to some regions of the world. But the stablecoin piece is I think where a lot of folks, including myself, get quite excited.
Nice. I think we only have like
something at the gas station with it. I mean, that's
yeah.
The next thing you actually use it once you can store it, but can you pay for something? So
Yeah.
I think I only ever bought like a jumper and a hat, and I think I overpaid for them. They eventually arrived, but yeah, I think we've kind of run out of time. There was another question there about Alameda and its exposure to FTX token. This is kind of a harbinger of what we saw with Cell and Luna, but don't know if we have much time. I think we've just ran out of time, so I think we might just
I think it's a good one to maybe close on.
Yeah.
But like long and short of it, just to answer that one very quickly, like look, there are firms that are systematically important to crypto, and Alameda is one of them. If you're concerned based on the numbers you saw, adjust your exposure accordingly, I think is probably the short version.
Awesome. Well, I think we'll wrap it up there. And yeah, thanks so much, guys. Really appreciate taking the time to speak with everyone. I think you guys are all in the US. I'm calling from Ireland, but got a sort of global team. Really appreciate it.
Cool.
All right.
Saved by the bell indeed, Adriana. Thank you for that comment. Cool. Adam and Block team, thank you for having us. Jeff and Andres, it was good to meet you guys. Cheers.
Likewise.
See you later.
Pleasure. Thank you, everyone.